This is one of those readings in the CFA level 1 syllabus, which has a beautiful integration of the core finance in terms of learning to look at different assets, especially bonds, mathematics, and accounting. So in order to completely capture the spirit of this reading, we have to have all the three pieces under control. We need to good with the basic accounting. We also need to acquire a little bit of bond valuation skill. And then we also need to acquire certain mathematical aspects around it. So this one is going to be fun. The reading is focused on three parts. We are going to record liabilities of a company, and we're going to record liabilities on three different dimensions. The first is that I am a company. I feel like I need to raise money, so I've decided to issue bonds. And I've decided to issue bonds, and I'm going to record the liability in my books. So how does that whole mechanism work? When I'm issuing bonds and I want to record liability, how do I do it? So that's the one part. The second part of the reading is, and this is where there has been a lot of changes in your syllabus this year in 2020. The second part of the reading is about leases, which is an extremely mathematical area, so to say. And in a very simple language, the way we want to look at leases is, I'm in need of an asset. Let's say as simple as real estate. So I go to a person who owns the asset, and I ask him, is it okay if he signs? We enter into some sort of a rental agreement or a lease agreement, where for next 10 years, I would pay you some fixed amount, like every month or every year, and then I would have the right to use the property. So this transaction, which apparently is so simple, where you're paying rent and you're using the property, this requires a very complicated accounting mechanism. So that's going to be the leases part. And this is where we'll also be doing reasonable amount of mathematics to fully comprehend this. And then the third part is that I've hired employees and I've promised them that when you retire, I will take care of your pension liabilities. So then how do I do accounting for the pension cost? How do I do accounting for the pension liabilities? That's what we would be seeing this reading. So three pieces: accounting for bond liability, accounting for leases, and then accounting for pension. So this is the area where we have to have discussion on. First, I'm going to start with the bond liability section. Now, your strategy for this reading is you participate in this session. You take notes of what I'm writing on the screen. So either you take a screenshot or you just note it down, and then directly go and practice questions. I'm reasonably confident you will be able to handle these questions after the session. So let us start with the bond part. Let's get some basics out of our way first. So just some sort of a warm up. So what we will do is we will try and value a bond using a simple YTM mechanism. Okay, so let's say we have a bond which has a face value of 1,000 and coupon rate of 10%. Let us say maturity of let me make up something random. Let's say 4 years, and let us say today at the time of issuance, the YTM of this bond is let me say 6%. Okay, so what we're going to do is we are going to build a timeline here. And what I want you to do is I want you to value the bond using the TVM row of your calculator. And get me the valuation of this bond at time 0. Is it a fair assumption that all of you know a basic bond valuation technique? We've also done this in the level 0 course. Bond valuation was discussed in the level 0 section as well. Okay, fair enough. Now I'm going to quickly repeat the keys for those of you who do not know. So see how do you value a bond? You just take present value of all the future cash flows. It's that simple. So whoever is buying this bond, what kind of cash flows he's looking at? He's looking at he will receive 100 in the first year. How 100? 1,000 into 10% coupon rate. He will receive 100 second year, 100 third year. He will receive 100 fourth year. And at the end of fourth year, he will receive 1,000. And these are the cash flows we need to discount at the rate of 6%. Okay, so let's do it together. All of you, it's a good practice for your fingers. Second clear TVM, 1,000 future value because we are receiving that in future. 100 payment, 1,000 future value, 100 payment. 4N, 6 IY, compute present value. Compute present value. How much is that? $1,138. Okay, so the value of this bond, the issuance price is going to be 1138.60. How many of you got this right? Just give me a me on the box, please. Just put in me on the chat box. Wonderful. That's great. Now let's take ourselves a step higher from this. Okay. Some people are asking me if I can repeat the calculated keys and why payment is not negative. So Siddharth, the way you want to think of this is whatever money you receive, you keep it positive. Whatever you pay, you keep it negative. So this 1,000 you're going to receive, 100 you're going to receive. Right? As a bondholder, I will receive 100, I will receive 1,000. So both of them should be positive numbers here. But when you calculated present value, your answer must have come negative. That's because we're going to pay this amount, 1138. So in general, one trick you want to kind of remember with bond valuation is the sign of payment and the sign of future value should always be same with bond valuation, because you receive the face value, you receive the coupon amounts. So quickly, the calculated keys were 100 payment, 1,000 future value, 6 IY, 4N compute present value. All right, now let's go a step higher from this. Let's say we have a bond with a face value of 1,000, coupon rate of 12%, maturity of 4 years, and YTM, let me keep a number lower than this 12. YTM is, let's say, I'm making up randomly. This is slightly exaggerated number, but just so that we learn a concept, 5%. Now, don't do any math. Without doing any math, tell me, do you think this bond will be valued at a price less than 1,000 or more than 1,000? It would be more than 1,000. Why would it be more than 1,000? Because it's a premium bond, because the coupon rate is higher than the YTM, right? So coupon is what you get in terms of cash. It's what you receive in cash. So since you're receiving higher cash here, it's a premium bond. But what if I make my YTM as 15%? Then what happens? If I make my YTM as 15%, then correct, then the bond becomes a discount bond. Then it would be valued at less than 1,000. So here's what I'm going to do. I'm going to keep that 15% instead of 5, and I'm going to draw this some sort of a upward directed arrow here. And this is going to be our strategy. In this section of this reading, there are 5 or 6 concepts you need to understand and maybe also remember. What I'm going to do is I'm going to convert all those 5, 6 concepts into one single shape, so that you don't remember the concepts, you just remember the shape, and it will do the job for us. So what you guys are going to do now is value this particular bond at time 0. The usual process. Value the bond at time 0 assuming YTM of 15%. Value the bond at time 0, assuming the YTM of 15%. So how are you going to do it? 1000 future value, 120 payment, 4N, 15 IY, compute present value. 1000 future value, 120 payment, 4N, 15 IY, compute present value. Right, so you're getting 914.35. So 914.35. Now, what you do is you assume, calculate the value of this liability or value of this bond at time one, but with the same YTM. Now, would you agree that YTM keeps on changing in the market? Would you agree that YTM is a number that keeps on changing, yield to maturity? Yes, but in accounting in general, we don't care too much about market values in general. Of course, there are a lot of exceptions, but in general, we're more concerned with the book values. So what we're going to assume, what we're going to call this number we're going to call as, this number would be called as YTM at issuance. So the day I issued my bond, the YTM was 15%, and that's the only number that matters for us. So keep the IY same as 15, but when I reach at year 1, the remaining number of years are only 3. So what you do is, in your calculator, don't do second clear TVM, just make N as 3 and then compute the present value. Make N as 3, overwrite the number, 1000 future value, 120 payment, 15 IY, but keep it as 3 now. So now you're getting 931.5. Now keep your NS2, and get me a valuation, please. Now do it fast, 951.2. Keep your N as 1, and get me a valuation, please. 973.9, and now keep it 0. Keep it 0 and get me a valuation. Keep it 0 and get me a valuation. 1000. And isn't it obvious? Because at the end of the maturity, I always get my 1000 back. So my bond price has to go to 1000. So can you observe this trajectory where if I keep the YTM same, I issue the bond at 914, but after 4 years, I know I have to pay 1000. 1000 hi dena padega, right? I'll have to pay 1000. So I keep this 1000, and then slowly, my 914 becomes 1000. So this concept in the fixed income world, we typically call this as a pull to par. Pull to par. So why par? Par is the face value. So any bond, eventually as it reaches to the maturity, it gets pulled towards this par value. Now, once you've appreciated this, here's what you want to appreciate. This sentence, which is super important for your exams. The book value of bond liability. Book value of bond liability. That means if I'm an issuer and if I'm recording liability, the book value of bond liability is present value of future cash flows, discounted at YTM at issuance. So you cannot say simply YTM, because YTM is changing throughout this period. We don't care about future YTMs. The only YTM we care about is YTM at issuance. So we stick to this 15% and we discount just the future cash flow, and we get the book value bond liability. So there you go. The first part of this section is already done for you. You already know how to record liabilities. Are you comfortable with this? Any questions you want to ask here? Okay. All right. So now listen to this question very carefully. This is where it gets very interesting. Let's assume you're the owner of this bond. Okay, you bought the bond. What is your annual earning here? Are you earning 12% every year, or are you earning 15% every year? Because every year you're going to receive 120. So are you earning 12% or you're earning 15%? Good. Many of you know the answer. That as an investor, even though it might look like I'm earning 12, actually I'm earning 15%. And how are you earning 15% here? So let's do a little bit of math. First year, what is the amount of coupon you received? At year one, as a bondholder, what is the amount of coupon you received? 120? 120? But is there also some other type of earning here? Like, are you earning from some other sources as well, apart from this 120? Okay, let me turn off my video for a while. I think there's some lagging issue again. All right, so my question was, are you earning, apart from that 120, are you earning from any other source? Yes. Where you earning from is the fact that you purchased the bond for 914 and no, you purchased the bond for 914 and by the end of year one in your books, the valuation went to 931. Because eventually, say as an investor, I'm earning from two sources. One is every year I'll get that 120. Every year I will get that 120. But second, I will also earn because I have invested 914, but at the end of fourth year, they're going to give me 1,000 back. Do you agree? So if you think from an investor perspective, he's not invested 1,000, he's invested 914. And at the end of fourth year, he's going to get 1,000 back. So that is also a part of the earning, which is slowly can be captured by looking at the difference of these two amounts. So can you quickly calculate the difference between 931 and 914? The distance between 931 and 914. How much is that? 17.15. So technically, as an investor, this is my earning. I've earned 120. I've earned 120 plus I've earned that 17.15 in the form of some sort of a capital appreciation. Now, this is my total earning in the year one. And in year one, how much did I invest? If I want to calculate my percentage return, how much did I invest? What money went out from my pocket a year ago? No, a year ago, right? This is my income today, but I invested 914. So I invested 914 last year, and today I received a return of 120 plus 17.15. Now, can you calculate in how much is this becoming in percentage terms? Very smart. Yes, that's correct. This will become 15%. Right? Isn't that crazy? That the investor is actually earning YTM, and we can mathematically prove it. That how did he earn? He earned from two sources. One is he received the coupon in cash, but second, he received not in cash, but he still earned that because his investment was worth 914. It became 931. So this 17.15, what we call this? We call this as amortization of discount. Amortization of discount. Okay, now some people find this fancy. Some people are like, "Ye itna bhari word kya hai? You know, what is that heavy word? What do you mean by amortization of discount?" So it's very simple. That you bought a bond for 914. It's going to get you 1,000 by the end of year four. So technically, you're getting a discount on the bond of 86. But as you go forward, slowly, the distance between 1,000 and the bond value is reducing. So that discount is reducing. And anything that reduces systematically is referred to as amortization. If you experience lag, let me know. So हुआ क्या कि 914 लगाया 1000 हो गया. You put in 914, it became 1000. So the distance, right? The distance is discount, and that discount is reducing slowly. Amortization means anything that's reducing in a incremental fashion. So how did we calculate amortization of discount? We took the difference between the two bond prices. But then the question you might want to ask me is, you would probably ask me, Utkarsh, does it work next? Will it work for next year also? And the answer is yes, it will work for next year as well. So let's see what happens next year. So next year, we will get 120 plus. Can you calculate the amortization of discount for this year now? The distance between 931 and 951. It is 19.7. And what do you think should be my denominator here? What do you think should be my denominator? My denominator is how much amount I had invested, how much amount was there accumulated at the end of year one, 931. So 931.5, and do the math, tell me how much. Again, 15%, right? Let's look at next year. Yes, Darshit, I've done it intentionally. Let's look at next year. Next year, 951 to 973. So 120 plus 120 plus. Can you now take the difference here? 22.7. Again, those of you who are lost, how did I get 22.7? 973.9 minus 951.2 divided by 951.2. How much? 15%, right? And finally, in the last year, again, 120 plus, tell me how much? 26.1. So 120 plus, let me turn off my video here. So 120 plus 26.1 divided by 973.9. Come on, now you know the answer, but I want you to still do it. It should be 15%, right? That's how the mathematics is working out. Now, those of you who've understood, give me a yes, and those of you who have not, give me a no. Excellent. That's impressive. Very good. Now, there is another way of looking at it. There's another way of looking at it. Okay, let us say Priya from our class. So what Priya does is, listen to me carefully, then you can ask me questions later on. Let me just finish the whole story first. So what Priya did is, Priya went, now Priya doesn't understand bond markets and any of that. So she went to an advisor and she said, if I buy this bond, how much will I earn? So the company says, or the advisor or the company says, you will earn 15% every year. She says, okay, no problem, I'll buy the bond. So she buys the bond. She puts in 914 into the bond account. Now this is year one. Now what Priya does is, she gets up early in the morning. She knows she's going to receive her interest today. So she opens up the calculator, and this is probably the only calculation she knows. So what she does is, she says, I've invested 914. I should earn 15%. So 914.35. I want to earn 15%. So multiply this with 15%. Tell me how much is this? It is 137.15. So now what she's expecting is, she's expecting that the company who issued the bond, they will deposit 137.15 in my account. So very happily, she opens her bank statement, and to her surprise, she's completely shocked to see that the company has deposited only 120 cash in her account. So furiously, she calls up the company CFO and she says, what is this? You guys promised me 15%. I'm supposed to receive 137.15, but you paid me only 120. So what about my remaining 17.15? So what the CFO says is, CFO says, yes, ma'am, this is how we've structured it. What you do is this remaining 17.15, आप खाते में जोड़ लो. खाते, I don't know, खाते ऐसे होता है क्या? खाते में जोड़ लो. Okay, what it means in English is just add to my account. So whatever is the outstanding amount that I owe you, add 17 to that account. We will settle it later on. So Priya says, okay, let me think about it. That means what you're saying is last year I invested 914.35 with you. And you're telling me that 17.15 you would pay me later on. That means, are you telling me, can you get a total? Can you give me a total, please? Do a quick total. 931.5. So then Priya says, are you telling me that next year you will pay me interest on 931? Because I will not accept if you pay me interest on 914. And the company says, the management says, yes, we will pay you interest on 931. She says, okay, no problem. So next year she's expecting to receive interest on 931.5 at 15%. Can you calculate how much? 931 into 15 percentage? 139.73. How much she received in cash? 120. So now she just calls to confirm the CFO and she says, are you telling me I should add 19.733 to my account? Khate mein jod lo. He says yes. And this happens for 2 more years. And that's how 914 to 931 to 951, that's how eventually she gets the 1,000 back. That is how a discount bond works. Make sense? Good. So here's what we need. Here's what we need from an exam perspective. Here's what we need from the exam perspective for these category of bonds. Let me create a new page here. Okay. So this is what I think will be tested, might be tested on the exam. So these are discount bond issued at a discount. Bond issued at discount. And on the exam, if you see a discount bond, then immediately in your mind, you think of an upward sloping arrow. That's the only thing I want you to know. On the exam, if you think of a discount bond, what you're going to think is you're going to think of this arrow, an upward sloping arrow. Why? Because your valuation is kind of moving like this. Now, number one, first observation, the bond liability. All right, I'll request you stop all the chat on the box for a minute. It could be a little distracting for other people. So all this side action that you guys have right now, just stop it for a minute, please, and focus. This is really important. You might end up getting one question out of next 5 minutes. So bond liability is going to increase every year. Bond liability is going to increase every year, right? How do we know that? Because first year liability was 914, 931, 951, 973, and so on. So slowly liability is approaching towards par. How can they frame it on the exam? They will say, there's a firm. One firm has issued a discount bond. What do you think will happen to the debt equity ratio over a period of time? So how you want to answer this is you want to think in the context of debt, because bond liability is nothing but debt. And every year the debt is going to increase, keeping everything else constant. My debt equity ratio over a period of time will go up. So that's the type of theory question you might see on the exam on this particular point. Second, the interest expense will increase every year. Interest expense will increase every year. So what is your interest expense? Is your interest expense 120 or is your interest expense the numerator here? What is your interest expense? The entire numerator, which is 120 plus the discount, right? 120 plus the discount. So can you observe, can you notice that every year your interest expense is increasing? 120 plus 17, 120 plus 19, 22 and 26.1. So another observation, interest expense will increase every year. So again, what kind of question on the exam? They will compare two forms. Let's say some premium bond, discount bond. Now let's worry about premium later on. Let's focus on discount. Discount bond issued every year, liability goes up, but what about interest expense every year? The answer is every year interest expense will also go up. So again, if you remember this arrow, it does the job. Then observation number 3, that this interest expense we can calculate using one of the two methods. How can we calculate this? So first we can calculate coupon amount plus discount amortized. This is my interest expense. So what is my interest expense for first year? 120 plus 17, 137. 120 plus 19, 138. So this is one way of doing it. Take the coupon amount, add discount amortized. Or second, take the value of opening liability and multiply with YTM at issuance. Take the value of opening liability or multiply YTM at issuance. Now, how does it work? So let's do a quick example here. Let us say we are supposed to calculate interest expense for year 2. Okay, hypothetical. Let's say we want to calculate interest expense for year 2. So we can use any of the two methods. Both the methods get you the same answer. What is the first method? What is the first method? Coupon plus discount amortized. So in the second year, what is the coupon we've paid? 120. And what is the discount amortized this year? So distance between 931 and 951. How much is that? 19.7. So what is my total expense? 139.7. So that's one way of doing it, which is coupon plus discount amortized. Or alternatively, here's what we can do. Take the opening liabilities. So when I'm at year 2, what was the liability at the beginning of the year? When I'm at year 2, what was the liability at the beginning of the year? The closing of year 1, which is 931.5. So take this 931.5 and multiply it with 15%. Do it. 931.5 multiplied with 15%. You would again get the same number, 139.7, right? So whichever way you do it, you're going to get the same answer. And then the final fourth observation. The fourth observation here, interest expense is going to be higher than the coupon amount. Interest expense is going to be higher than the coupon amount. Look at each of the year. For example, year 3. Year 3, can you tell me what is my expense? In my profit and loss account, what expense am I going to show in year 3? In year 3 here, in this year. Come on, I want everyone to answer. What's my expense in year 3? Expense, interest expense, not cash outflow, interest expense. It is going to be 142, right? The total of these two, 120 plus 22.7. So in year 3, my interest expense is 142.7. But what is the amount of coupon paid? What is the amount of coupon paid? 120. So can I conclude that interest expense is higher than the coupon amount? Is that a fair conclusion? Yes. So there you go. these are the 4 areas that you need to work on. And if you've understood these 4 areas, then more or less you've understood how to account for bond issued at discount. So now it's your time. I've done my talking. If you want to ask any questions, I'm going to take a 30-40-second pause here. You can post your questions and then I'll try and reply them. All right, first question. Amit is saying that interest is only 22.7. No, sir, Amit. Interest is not 22.7. It is coupon plus discount. 22.7 is just the discount amortized. The distance between 951 and 973. Your interest expense is a total of coupon plus the discount amortized. And one request to you, by the way, all the people, I'm also streaming this session on YouTube. It wasn't a scheduled session. I'm not sure if anyone is even attending that. Let me just go and check. Now, if there's anyone, I'll probably try and answer some of the queries there as well. Oh, wow. Just go and check. We do have a few people. All right. So if you have any queries, including the ones on YouTube, you can post them on the chat box now. Let me. Vishal wants me to repeat. Vishal wants me to repeat point number 4. Okay, Vishal. Point number 4, interest expense greater than coupon. Okay, Vishal. So my question to you. Okay, just think about it. If you are issuing this bond in year, take any year. For example, let's take year 2. What expense will we show, Vishal, in our profit and loss account? Interest expense. You're the issuer of this bond. What interest expense will you show in year 2? You will show the total of 120 plus 19.7. But what is the coupon amount? What is the coupon amount paid in year 2? Coupon amount paid in cash to the bondholder in year 2, 120. So can I say interest expense 139.7 is greater than coupon amount 120? Is that a fair statement? That 139.7 is higher than 120? Right? So, and it is true for each of the year. So it is true for each of the year. Interest expense is greater than the coupon amount. That's it. Straightforward. That's correct, Pratishta. Let me take next question. For every question, do we need to remember this? No, Parth. You need to remember this for a discount bond. If it's a premium bond, we'll go there. Now, this is a great question asked by Rohini Rao. The question she's asked is, what will be the accounting for the second effect of interest expense as we're paying only 120 cash? That's great, Rohini. So if you want to see this from an accounting perspective, what kind of accounting entries will I pass? So first, in my profit and loss account or in my income statement, I will show an expense of 139.7. So we typically call this as a debit, right? So we will say that we have now those of you who know accounting, focus on this. And those of you, who do not know debit or credit, just ignore this accounting nonsense. But I will pass a debit entry and expense 139.7. Now, what is the corresponding entries? So 120 worth of cash goes out. So my debit reduced. So now I'm left with only 19.7. Now 19.7 worth of liability increases. So my credit increased. So effectively, my books will tally. I'm repeating one more time. 139.7 expense, 120 cash goes out, and 19.7 liability increases. So again, in a very easy way to think of this is forget interest, forget this is salary. Okay, just to help you think. Think this that this is salary and total salary expenses 139.7. Out of that 120 you paid in cash, 120 आपने cash में दे दिया, 120 you paid in cash. 19.7 you'd show a liability, but there is already some liability, so you'd add 19.7 to it. That is exactly what we're doing. Our liability earlier was 931. We added 19.7. It became 951. That's it. Make sense, Rohini? Okay. All right. So let me give you a practice question on this now. I think after my practice question, things would be even better. If you need to take a screenshot, I'll recommend you to do it now. My software, as I said, is a little unstable, so I might lose some of these images. All right, super cool. Harry, just write to our admin team. They should be able to help you there. All right, so let's do a beautiful practice question. What is Sahil's question here? Sahil, can you post your question again? Okay. I'll keep that on hold and answer that. Okay, fair enough. So let's say we have a face value of 1,000, coupon rate of 12%. Let's reduce the coupon. I'm sorry. Let's reduce the coupon. Let's make the coupon as 6%, and let's make YTM as 10%, and let's keep the maturity as 5 years. Okay. Now, what I want you to do with this is question number one. Question number one: build our usual this beautiful looking arrow and calculate the liability for each of the year. Then, so calculate the liability for each of the year. Then in question number two, calculate the interest expense for each of the 5 years. Then in question number three, calculate the discount unamortized for each of the 5 years. Then question number four, calculate discount amortized for each of the 5 years. And then question number two, do it using both the methods. Which are the both methods? The direct opening liability into YTM method or coupon plus discount method. If you can solve this question, more or less the discount bond treatment is done for you. I'll give you probably let's say 4-5 minutes to deal with this, and then we will solve this together. Get started super fast. Sangeeta is asking me if this is a premium bond or a discount bond. So very easy way to think about it, Sangeeta, is coupon is what you're receiving in cash, not what you're earning, but what you're receiving in cash. So are you receiving more or receiving less? compared to YTM. Receiving more or receiving less? You're receiving less, right? 6 is lower than 10. So if you're receiving less, it's a discount bond. Come on, do it fast. Are you guys done? Okay. All right. So here's how we're going to do this. You guys help me with it, please. First, we'll figure out whether it's a premium bond or discount bond. What do you guys think? Premium or discount? Of course, a discount bond. The coupon is lower than the YTM, so it has to be a discount bond. So there you go. Let's prepare this nice little upward sloping arrow here. Now, time zero, time 1, 2, 3, 4, and 5. I'll do time 5. You do rest of the numbers. Time 5 is going to be 1,000 because eventually you want your bond to be priced at 1,000. Now you help me with time 0 value, please. The maths is going to be 1,000 future value, 60 payment, 5 and 10 IY. So that's going to be 848. 848.36. Now make 4 as your N and get me the next valuation. That becomes 873. I'm cutting out on the decimals. 873. Next one, 900. So now someone on YouTube asked me, wouldn't the market value fluctuate in between? The answer is yes. Since the YTM in the market is changing continuously, so it's quite possible that in the market, this bond today, when in my books it is at 900, it is at 970 and 980. These are not market values. These are book values of my bond liability. And as far as book value bond liability is concerned, the only YTM that I care about is YTM on the date of issuance. Can you tell me what's the liability here in year 3? 930. Year 4 liability is 963, and there you go, we have 1,000. Okay, now let's prepare a nice chart out of this. Let's go with the blue this time around. So first year, we'll break it down into those 5 pieces. One. Now after this, I think things are going to be nice and easy for you after this example. So whatever small doubts you might have had, I'm hoping that after this you will be crystal clear with it. So time 0, 1, 2, okay, 3 and 4. I'll have to go right up to the bottom of the screen. So first time 0, 1, 2, 3. Bad planning. Time, okay. 0, 1, 2, 3, 4, and 5. Now, first thing we'll do is we'll write down just the bond liabilities. Okay, so let's plot these liabilities into our table. So 848, I'm ignoring the decimals. 848 848, 873, 873, 900, 930, 963, and 1000. Now we would calculate something called as unamortized discount. Okay, so again, some of you are asking questions about, uh, why isn't discount increasing, decreasing, all of that stuff. So that would make sense to you now. Unamortized, not amortized, unamortized discount. And what is unamortized discount? Really easy, very simple. Unamortized discount is nothing but the value of your bond, and the face value, the difference between the two. So you tell me your bond has a market value of 848, but it has a face value of 1000. What is the value of discount today? Like, what's the difference between the two? 152. So at time zero, when we issued the bond, the total discount was 152. The total discount. Now this discount we are going to slowly reduce. That's why we use the word amortization of discount. So at year one, the bond price is 873, face value is 1000. What is the distance between the two now? 127. Has it reduced? Has it come down? Has it come down from 150 to 127? Yes. That's why we say we are amortizing the discount, right? We're slowly reducing that discount. So now what is the distance here? About 100. What's the distance here? 70. We're reducing it further. What's the distance here? Now we're left with 37. And finally we're left with 0. Are these numbers correct? So now this is called the unamortized discount. Okay. Now then, how do I calculate amortized discount? How do I calculate amortized discount? So there are two ways of doing it. One, you look at by how much your liability has increased, or second, by how much your discount has decreased. It's the same thing actually. Okay, it looks a little confusing initially, but let me show you how the math works here. So it works somewhat in this fashion. Now, year 0, we will not be able to do it. We'll do it for year 1. From year 0 to year 1, by how much your liability increased? The distance between 848 and 873, how much? So let's round it off to 25. This is called discount amortized. Or you can also do it as a distance between these two, 152 and 127. How much is that? 25, right? So either you do it this way, it's going to be the same answer. Are you understanding this? But I'll recommend you do it from a liability amount. It's easier. The amount by which your liability is increasing every year, that is your unamortized discount. So do it for the next year, please. 127 to 100. How much? 27. Then how much? 30. Then how much? This is 33. 33 and 0. Now let us calculate interest expense. Let us calculate interest expense using this method. Method 1, coupon plus discount amortized. Okay, let's use this method, coupon plus discount amortized. Coupon plus discount amortized. Okay, sorry, I think I missed on something. The last year is not 0. I made a mistake here. The last year is 37. Thank you very much for helping me there. This is 37. Okay. Now let's calculate interest expense, coupon plus discount amortized in year 1. What is the coupon we've paid in year 1? No, coupon. What is the coupon we paid in year 1? So every year we are going to pay 60. So every year we're going to pay 60, 60, 60, 60, 60, and 60. Plus, 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 plus. What is the amount of discount which has been amortized in the first year, 25, second year, 27, third year, 30, then 33, and then 37. So this is your interest expense. Method one. Method one. Now, interest expense, method two. What was the method two? Do you remember the formula? What was the method two? Method two was opening liability into YTN. So when I'm at year one, what is my opening liability? 848. And what has been the YTM? 10%. So you do it this way or this way, you get the same answer. Same story here. 900 into 10%. Now there's a little bit of rounding off differences here. So it may not match precisely. That's because we've ignored decimals. But if you do it on an Excel file, it will match precisely. Next year. And I should have taken 873 here. 873. 873. That's my opening liability. 900 comes in here. 900 into 10%. 930 into 10%. And final year 963 into 10%. Got it? Good. And have we covered everything? Yeah. So this is how you solve this question. Easy. Okay, now those of you who have still not understood this, give me a no on the box and then you can frame your question. Those of you who feel you've not understood this, bolo yaar, sharmao mat, be honest with me. Okay, first question I've got from Amit. He's asking, what is an unamortized discount? Amit, it is the difference between the current price of the bond and the face value. So for any year, you do the calculation, see if it works. Take the face value, take the current price, take the discount, take the difference of the two. Yes. How will they ask on the exam? So they will give you a bond. Okay, there's a slow internet. It might lag a little. Okay, so what kind of questions will you get on the exam? They'll give you a bond. They'll probably ask you, they'll ask you, how do you calculate interest expense in, let's say, in year 2? Or they will ask you some theory question which checks that your conceptual understanding in terms of how interest expense is to be calculated using either method 1 or method 2. Shruti wants to know what's the method 2. Shruti, this is method 2. The interest expense can be calculated in 2 ways. One is coupon plus discount, or opening liability. That means the closing liability of last year multiplied with YTM at issuance, the original YTM of 10%. So जो साल के शुरुआत में liability था, the liability I had at the beginning of the year, which was the closing liability of last year, that into 10%. So we've done the same stuff here. Opening liability into 10%. Will there be any questions on impact on ratios of these bonds? Of course, yes. But if you know this framework, you should be able to answer ratio questions as well. Why is it called unamortized? That's because we are going to amortize it slowly. So if you take the total of these 5 amortized discount, 25, do it. 25 plus 27 plus 30 plus 33 plus 37. Take total of amortized discount. Tell me how much is that. Take total of 25, 27, 30, 33, 37. How much is that? 152. So at time 0, it was unamortized discount. So total discount is 152, the difference between the issue price and the face value. And then slowly, you're making that 152 0. So slowly, slowly you're amortizing it. That is why 152 is unamortized discount, and then slowly, slowly it gets reduced. So first year when you reduce 25, you're left with discount of 127, and then so on. Excellent, good. I hope you enjoyed this section. Now we're going to take a small break. I think I need some round of coffee for myself, but we'll keep a short break, 10 minutes. And then after the break, we will continue with premium bond, and then we will do a little bit of leases, and then we will also do the accounting for pension. So that's it from my side. The YouTube session ends here. Thank you for logging in, guys, and stay tuned. And I will see you in 10 minutes time now.